Well, what is going on, guys, and welcome into the video. Well, this video applies to every stock in the stock market, not just Apple, so the points made in this video will absolutely apply to every one of you guys out there, even if you're not into Apple at all. So if you own Tesla or Google or any other stock like that, the points I will make here can be applied to all of them. There's actually probably 3 or 4 videos worth of content that I will give to you today in just one video. So I just asked in exchange for you to gently tap that like button and consider subscribing too. It's super easy to do if you like the truth without the hype. Now there's a lot to unpack here and a lot of lessons to go through, so let's just jump straight into the video, okay? And don't worry at all, I won't play the whole 13-minute video just to get more ad revenue or any other crap like that. I'll cut it down to the important parts only.
We start off with the Chartmaster's big warning on Apple. His latest note calling an end to the tech giant's 8-week run in which it gained nearly 30% and climbed within 5% of its all-time high. Let's bring in Carter Worth of Worth Charting. Carter, our viewers know you quite well. You're a man who is level in your emotion, and yet this call went out today and it had exclamations in the headline, and that really caught my eye. So walk us through.
Well, hold on. Yes, but no exclamation points. I hold back on those. But certainly, in fact, to write "sell it all" is certainly definitive, right, and emphatic. And here's the thing: we know before we look at the charts, we know that what makes a market is just exactly what you see in Apple. It's the largest stock out there. It's 7.3% of the S&P, and it's covered by some 40, 50 analysts. In fact, there are people whose 12-month price targets are as high as 220 and as low as 140 from top 10, top 5 brokerage firms. And there is the rub. How can one man or woman or one analyst think it's worth 220 and one think it's worth 140 with the same access, the same information, the same spreadsheets, Q's and K's?
All right, let's stop right there because the answer is actually simple. Contrary to what any YouTuber tells you or anyone else, it's actually quite simple. Valuation is much more of an art than it is a science. There is no formula to not only predict where a stock is going, but where fair valuation is as well, or anything else like that. Now yes, a formula is used to derive a number, but the inputs are not all the same. You have to make assumptions, and everyone will make different assumptions when modeling this whole thing out. Look at PE, forward PE, run a DCF model, run the software that many people sell, and absolutely every one of them requires you to make assumptions and put those in as inputs along with the hard data like revenue last quarter, for example. And in many cases, just adjusting those assumptions just a little bit, just 1% or even 0.5% makes a huge difference in the number the formula produces at the back end. There is no formula that just tells you what fair value is, and there is no software that tells you where a stock is going. There's absolutely none. It doesn't exist, guys. I'm sorry.
Could fear, Carter, in this market context that we're in, keep that unnatural line unnatural?
Well, I mean, certainly you can get, as the expression goes, overbought or oversold and stay that way for great periods of time. But if one were to use oscillators, I don't particularly, but you could look at a MACD or an RSI, you could look at a Bollinger Band, or one can just look at where this is in relation to where it's been. A move like this is hard to sustain much longer. And at a minimum, if one's long, you take a little off, or you write some calls. Or if you have the dexterity, you try some options to do something rather than just blindly stay long.
Right. Carter, thank you. Carter Braxton Worth. And we have.
Yep, that's actually very true right there. Stocks can stay overbought or oversold for, in some cases, years at sometimes. It has happened to Apple many times before, and it absolutely will happen again, and it's going to happen with any stock that you own. I'm not a trader, so I don't make moves based on that, and everything he just mentioned, Fabro, Macro, Pizza, Deco, whatever, are all just technical indicators. Now, they're very important for traders. I know that was ridiculous. I'm sorry. I'm out of control here. I need to get control. I'm sorry. They're very important for traders, but as a long-term investor, they're not really all that important. I don't think Buffett bought a single stock because the Fabro whatever traced back to this level or signaled this or that or whatever. He was much more worried about, finding a great company. That's number one. And then number two, buying it at a great price. And then number three, holding it for the long term and letting the fundamentals take care of the stock over that long term. He would take a company with a great product and great management team anytime over any technical indicator showing a stock as a buyer or a seller or whatever. But he is not a trader either, and neither am I, to be honest. And that is why we don't follow those types of things. So I just kind of want to make that clear, guys, as to what's going on with that.
Dan Nathan, what do you make of this?
All right, well, listen, I got this email from Worth Charting today, and I immediately thought about dexterity, okay? There were actually exclamation points in my head because I've been looking for a reason why this stock should correct a little bit. I agree, that slope is unnatural. And when you think about that 35% rise that's pushed this valuation. I know Tim will have a lot to say about this. 27 times for a company in the out year, okay? So we're 1 quarter away from their fiscal 2023 earnings and revenue guidance. They're expected to be mid-single digits here. So when you think about how unnatural of a move that is, maybe it gets back to that 182 all-time high high on January 2nd. Maybe it gets back, maybe only to 180, the high in March or so. I think the risk reward sets up really well to the downside here. I bought puts in September, looking out a month. If you look at implied volatility, the price of options right now at 24%, in line with the historical vol, how much it's been moving. That says to me that directional bets using options long premium look very attractive. So that's what I'm doing. I'm looking down. I'm risking about 2% of the stock price over the next month for a 4% break even to the downside. I like that risk reward here.
Honestly, I don't like it for one simple reason. That was a lot of complexity, a lot of assumptions, and a lot of jostling for just a few percentage points gains or just to get stocks a little bit cheaper than what they're at right now. That hardly seems worth it to me, for me in the first place. I don't have the time to sit around and figure out how to potentially squeeze out a few extra percentage points on my investments, and even those are not guaranteed at that point. I don't run a fund whose investors want real returns right now where that is necessary, and they absolutely have to do that, and more importantly, that's his actual job. He gets paid to create those types of returns with doing those sorts of things. I don't get paid for doing that. So for me, I would much rather spend my time making money to buy great stocks instead of trying to eke out a few more percentage points on my portfolio. Remember, he gets money from investors through their marketing team and various other things like that kind of bring money in. I get my money by working just like most of you guys out there. So my time is much better spent doing a side hustle, starting a business, working overtime, whatever to invest more in great stocks instead of spending that time trying to eke out a few more percentage points on my portfolio. Now, maybe I'm the only one. Who knows? I don't really honestly know. But this, for me, is a colossal waste of time and adds needless complexity for my situation personally.
How about the reports that Apple has signaled to suppliers that it plans to sell as many phones as it did last year, Karen? And the cash on the balance sheet. Shouldn't this stock have a premium because of how fortress its balance sheet is in this market environment?
Yes, it should have a premium, and obviously they do have a gigantic cash hoard, but all of that is known and already should be reflected in the marketplace, right? They told us that about how many phones that they could sell as many phones as they could. So I think all that's reflected in it. So normally, I don't like to trade around a long-term holding, but I actually, looking at the multiple here, because remember, a big part of this multiple is hardware multiple, which should be much lower. So that means you're getting a much higher multiple for the services. And in this environment, and with rates going up, I feel like the multiple is too high. So I will look to buy some puts instead of selling it. And if you're a long-term holder, you can buy puts, and you don't need to realize a gain. It stops the clock, but if you're already long-term, it doesn't matter. Ultimately, when you do sell it, it will still be long-term. So it's tax efficient for me to buy a put, and I think that's what I'm going to do, buy puts against my position, because it has come too far, too fast.
Guy, excuse us. We're on television right now. Yeah. Are you actually on the phone?
No, I'm actually putting on some hedging strategies.
It is after hours, so you can do that on certain trading platforms, apparently.
All right, again, just more trading strategies presented as good ideas to long-term investors. Now, let me be clear here, there's nothing wrong with any of that, but I like to keep it simple and don't feel the need to do all this stuff. But what you do hear in this, and this is kind of the reason why sometimes these articles and these videos are actually very useful in understanding what's going on with the actual market, is that you also hear the strength on Apple right there. And this gets missed by a lot of traders. They have an impeccable balance sheet. They have mountains of cash. Apple doesn't tell suppliers they are able to sell everything they deliver unless that is actually true. And they have a multi-decade track record of delivering on those promises when they make them. So what does that tell me as a long-term investor? Well, honestly, it tells me even if I bought today, even though I think it's trading a little rich, maybe even a lot rich, Apple is still continuing to deliver despite all the challenging things going on with supply chains and the economy and all the headwinds that are going on right now. They are crushing it, so even if I did buy today, over the long run, everything is intact for that buy to look great in 3 to 5 years. But that doesn't mean I'm just jumping out there and buying it either. To me, it is a little bit overextended. Now, how far it falls back down remains to be seen. I mean, it could very well just trade flat or trend down, just a little bit. And then after a quarter or two, or maybe 3, the valuation makes more sense again. So you didn't get a big drop on price. I just buy simply on valuation and the price I am willing to pay in relation to where it's going 3 to 5 years from now. I bought Apple last year at $117. And you could buy Apple in June for around $130 or so. You get opportunities to buy all stocks periodically at great prices in relation to that valuation. I mean, Tesla could be had for $640 or so in June and in the 500s last summer. Bargains on great stocks do happen periodically throughout the time in the market. But you don't have to wait for those either. I mean, a simple DCA every week or every 2 weeks gets you great results over the long run. And the math has proven that out over and over and over again. Or maybe you do a modified DCA like I do and many in our group do. I mean, one example of that would be you buy a stock on a schedule, and if it drops below a certain mark, you deploy some extra side cash you have sitting around for that special stock that you have in your life. Or if you're comfortable setting price targets, set one, and when the stock gets there, just continue to DCA into that stock until it goes over that number again, and just kind of rinse and repeat that cycle. Who cares if it goes lower? I mean, then you buy more because that is your plan in the first place. I happily bought Tesla in the mid 700s, for example, and then it fell to around the mid 600s again in June, and I bought more. I didn't wait because it might go lower or some YouTuber or the media said this or that or whatever. I simply followed my plan and DCA'd accordingly when it got below my target, and I'm very happy that I did. Over the long run and through every crash and recovery, the best, most reliable strategy is to buy and hold and buy again. Not shorting, not getting in and out of positions or anything else. Now, I'm not saying you can't make money in those, you absolutely can, but the best overall strategy with the highest success rate is to buy and hold and buy more through the whole cycle. So hopefully this was helpful, and if you don't know how to get a price target or how to do evaluation and want a step-by-step process for doing that, building wealth, and you want direct access to me and much more, remember to check out the pinned comment down below to become a member and at least look at everything you get. And click this video here for the stocks I'm still buying in this market, and click here for exactly what I'm doing to make huge money in this market. So thanks for watching, and we'll see you in the next one.